All right, it's estimated that mortgage servicers are going to have to process about 18,000 forbearance exits a day in the fall. So we'll see if that works out. I got my doubts, let me tell you. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Today is August the 11th. Randy Patrick here, putting the realism back in real estate. Hope everyone's doing well. There is a lot going on these days, and I can basically say that I think the housing market has shifted for various reasons. If you're looking at newswire information, internet, whatever, you can see that there's more and more, we'll say, discussion points and articles, sort of moving away from, low inventory, low interest rates, values rising, et cetera, et cetera. Now it's like, hey, we're seeing more inventory coming on. We're seeing more listings. We're seeing some price reductions. We're seeing more competition. So things are indeed changing, and it's long overdue, and let's make sure that we get into it right now. So as I always say, and so it begins, this is my new saying, so July 31st, why was that date significant? For a couple of reasons. The foreclosure and eviction moratorium expired. Now, this is the one with respect to the government, so Fannie, Freddie, FHA, VA, etc., those type of government-backed loans. So that foreclosure moratorium officially ended. So we'll package that over here. On the other side, the CDC moratorium, which really dealt with evictions for tenants and renters, that expired and was sort of brought back under a new, we'll call it, umbrella via the CDC. And the past week, all I've been reading about is it's illegal, it's unconstitutional. Landlord groups, other real estate groups are freaking out, and they're suing the CDC and doing whatever they can. So this has become a little more political hotbed. Listen, on a personal note, I mean, we know that there's got to be some sort of transition period, for the landlords and the renters. But the real problem is getting the money in the hands of the landlords. So there's a lot of money that's been allocated to rental assistance that just can't get out to the people who actually need it, and that's what's causing problems. So it's a big cluster. We all know that. But again, that's a separate item. I just want to point out that that's where housing has now become somewhat political, and we'll be dealing with that as time goes on. All right, I'm still dealing with some, I guess you could say, technical issues here. I had to purchase a new Mac, which I'm trying to get everything set up on that. So I'm working on some old stuff right now. That's why I've got another monitor here. If you see me look to the side, I got to look at what's going on here, but the camera's here. All right, just the way we're trying to set up here. So just bear with me. So this is what came across my, I guess my email first thing this morning. So it's from the Tampa Bay Business Journal. Foreclosures dramatically increase in Tampa Bay over last year. So this is an example of what I'm saying. So the housing narrative for the past, since COVID, has been about moratoriums and forbearance, and we've moved into skyrocketing home values, and the narrative really boils down to, people who have forbearance or are facing foreclosure, everything's going to be great, everything's going to be fine. Why? Because you're simply going to sell your property with all the newfound equity you have, and you're going to move on. Move on to where? I don't really know. Because if housing values are still high, you can't jump in a new house, clearly. Rental prices are skyrocketing. Where are you going to go? So this is where we have kind of what's called a conundrum, and things are going to be very difficult as time goes on. But I just want to point out that, so in my area, and this is in different pockets across the country, it's going to start to pick up steam. We're now seeing, talking about foreclosures increasing, and that'll be a topic, and that'll be a point of interest and a guess you could say a target for real estate purchasers, investors as time goes on. So definitely some interesting stuff here. From my first statement in the video here, servicers may need to process 18,000 forbearance exits a day this fall. So ultimately what happens with forbearance is that the forbearance plans are ending. So what that really means, if you're in a forbearance plan, a typical forbearance plan is a 6-month plan or program, right? Once that expires, you can opt in for another 6 more months. Once you've hit that 12-month forbearance program, you've essentially exhausted the forbearance opportunities. Now, if you're in a government-backed loan, the government has increased on a couple of occasions people who could remain in forbearance. And that's all based on when you jumped in, all right? So if you're jumping in now, you're not going to have the benefit of all the 18 months or whatever, then 15 or 18 months, whatever that is. But the whole point is that a lot of these forbearance programs are expiring. So if you're in it and still in it, you've got basically maybe a month and a half left now. And end of September, a lot of this stuff's going to expire. So this is what we're talking about, this 18,000 forbearance exits a day this fall. So it's just an estimate. Now realize that statistically speaking, I really believe this is an underestimate. Why? Because we all work on this one statistic that seems that the mainstream media uses to, I guess you could say, package the distress in the real estate marketplace. So we talk about the forbearance numbers, which please remember, it's a, I guess you could say it's based on an extrapolation from samples taken from 70% of the banks and servicers out there. And it's an estimate, and it's done on a weekly basis. So we hear from Black Knight Financial, other people in the news going, oh, we're down to 4.2%, that's 1.7 or 1.8 million people in forbearance. So really, as I said, it's an underestimate because we know that there's actually more going on. All right. But my point here, though, is that 18,000 forbearance exits a day this fall. So after the end of September, now all the people who are in these forbearance programs will be expiring, and there's no other alternative for them. So what has to happen is you've got to figure out your mortgage. So are you going to either pay your mortgage, go on paying your mortgage, and if you can actually pay your monthly mortgage, they're going to take that that forbearance missed payment and put it in the back of your loan. There'll be loan modifications if you can't do that. The government, the Biden administration, has created a principal and interest reduction program. It's designed to actually reduce your principal and interest part of your mortgage by 25% and putting that at the back of the loan as a separate lien to be repaid upon refinance and or sale of the property. But realize it's not 25% of reducing your payment. It's 25% of reducing the principal and interest of your payment. So taxes and insurance. So PI is principal and interest. PITI, principal, interest, taxes, insurance. That's your typically mortgages have that all bundled in right now. So realize it's not your entire payment. It's reducing the PI part of it, the principal and interest. So it's not going to be as I think great a number as people would expect if they're just hearing it off the cuff here. But the whole point I'm trying to make is that it's going to be chaos. So if you have 18,000 forbearance exits that are going to be happening per business day in the fall, that's a ton of volume. And based on the last housing crisis, and we had chaos and a ton of volume, what happened? Well, I can tell you what happened because I was living it with clients and stuff. That's why I'm talking about the realism back in real estate here, okay? The volume will be too high for the servicers to handle. Now, of course, the CFPB has already made comments and sort of strong-arming the servicers back a few months ago saying, be prepared for this, have solutions, staff, whatever. But you really don't know how it's going to play out, okay? So what happened in the last housing crisis? Well, I can tell you that the government did put programs out. Lenders did have loan modifications available, but they couldn't handle the volume. They lost documents, didn't get documents from homeowners, blah, blah, blah. A lot of homeowners became frustrated. Stuff fell through the cracks, and that was a big issue. So that's what happened last housing crisis. People that probably could have had loan mods or could have at least bought more time on their homes lost their homes before foreclosure just because of the administrative, cluster that this whole entire process was. So I would expect that we would see something similar based on the fact that if we're talking 18,000, per business day going to the servicers, that's people, okay? So people have to call in. They got to service them. They got to call back. You got to opt in. You got to figure stuff out. You got to send in. Like, here's the thing. To do loan modification, you don't just call up and say, I'd like to do loan modification. They go, okay, fine, you're good. Oh, you get some documents. You get like a loss mitigation package. You got to fill that out. You got to send that in. That has to be analyzed by an analyst there or somebody in the lender. It's got to meet a certain criteria. It's got to fit the numbers, and then they have to make it work for you, or you have to agree to it. So you see, this is where, so it's not like, hey, press a button and call or go online. It doesn't work that way. That's why we're going to see a lot of chaos here. So what happened last housing crisis? Homeowners couldn't get assistance. Many just simply fell through the cracks. And what happened is their frustration led to just giving up, and they let their homes go to foreclosure, which is a very sad thing. So that's why I say cue the foreclosures, because once the stuff starts happening in the fall, the foreclosure bucket's going to increase, because I can just tell you that people won't get serviced, okay, and it'll be mayhem as far as I'm concerned. So you'll probably see the next little while all these servicers and lenders looking for staffing, new jobs, whatever. But it's going to be a pain. I can tell that right now. So cue the foreclosures, which means more people are going to go, I better sell. And if they're going to sell, then they're going to be entering the market. And entering the market basically means if I'm entering the market and so are you, and so is a person down the street, now there's competition in my area, my neighborhood, my street, which means I have to now reduce price point. So, and value should decrease because of that, because it's a supply-demand factor, as we all basically know. Why is everything so expensive now? Because of lack of inventory, so to speak. Supply and demand, low interest rates, everything's fueling this fire on house price appreciation. Suddenly, when a bunch of people who are distressed come on the market, and these aren't foreclosures or short sales, yep, these could be people just with equity saying, okay, I'm going to sell now. But you know what, though? Taking that equity that you think you have, which is also based on the housing narrative. And the housing narrative, for some journalists out there, are basically the premise is we won't have problems. You're going to sell today because all this newfound equity, you'll walk away and life will be good. Well, that's great. So if I'm the only person on my street that's facing this situation and I put my home out there, yeah, I'm probably going to get a good price, so I might be able to cash out. Also depends on where you are in the country, your location, number of foreclosures, whatever. But the point is when multiple people in the neighborhood or street start coming out of the woodwork and putting their homes up for sale, then guess what? The natural progression is to push values down and compete. So we will shift from a seller's market into a buyer's market and a more distressed market as time goes on. So that's why I say the housing narrative today might be solid, and it could work, but in a few months it's not going to be the same, and we're going to see things change. And that's the funny thing is that, as I always say, when they push the narrative so hard and they want you to look over here, but really they don't want you to see the problems that are brewing over here. And that's where we're all going to get caught. So please keep that in mind. So that's kind of my position on this, which I think you understand that. Now, if you want to get involved in the game and actually see what's going to happen in your local housing market, go to gethousingdata.com. That's gethousingdata.com. It's my partnership with foreclosure.com. You can take a look at all the pre-foreclosure and auction listings in your area. They're the number one provider in the country of distressed property listings. So check that out if you want to know what's happening in your area. All right. So funny enough, today, I look also, we see that Adam Data Solutions has also produced their U.S. foreclosure activity for July 21. And ultimately, as we know, the moratorium just ended, like the foreclosure side moratorium just ended July 31st. All right. So what's going to happen now after July 31st? Well, we're going to have people who had their foreclosure sale dates or auction dates canceled before. Well, they're going to get refiled and they're going to get reset for the future. We're already seeing that in some of the locations around, well, I know in Florida for sure, and around the country, we're going to see those things get reset. If you were in the foreclosure process prior to COVID, well, your case or the filing will just start up and resume. So that's going to pick up, all right? And the fact that if you are in a situation where you're not under any forbearance program, because realize that unlike what mainstream media tells us, there is a lot of people that are not or delinquent on their mortgages that aren't in any forbearance program. Not because they don't qualify, just because they haven't done that yet for whatever reason. So keep that in mind. So all this backlog will start to actually go in what's called notice of default or lis pendens. So foreclosure will start in various locations across the country. So we'll start seeing some volume. And then what's going to happen, we're going to have the forbearance people that are going to follow forbearance, etc. So that's all the stuff that we're going to see. So keep this in mind, all right? So what I want to talk about here is the fact that in this article, they're basically saying the foreclosure activity decreases as the government moratorium comes to an end. So of course it's decreasing. Why? Because as of July 31st, there really wasn't much happening. Yeah, some were squirting through, etc. But really, if you think about it, it wasn't a heck of a lot. So that's what I'm saying. We're going to see a lot more coming down the way in the next little while here. So now, what I've noticed though is still part of the housing narrative. And I mean, as I said, everyone can create narratives. I guess I have my own narrative here, and I'm not, shying away from it. But the whole point is that there really is a push now to not talk about the negativity in the housing market. I've really seen that with respect to what's going on. A lot of people like this group here on the screen used to talk about things a little more openly on number of foreclosures, whatever, and that's changed over the past number of months. They don't talk like that anymore. So as they say here, the end of the government's moratorium won't result in millions of foreclosures, but we're likely to see a steady increase in default activity for the balance of the year. Well, you know what though? If you take a look at the numbers that people are talking about, and again, we're going back to the mainstream talking about the forbearance group as being the only distressed group out there. Not the case. That is one segment. We have another segment which I talked about, those that are delinquent, not on any forbearance. That was estimated a couple months ago to be about 1.8 million. So, we're talking about 4 million probably plus minimum. And then we've got people saying, well, we're looking at 6, 7 or up to 10, 11 million. So there's just things that aren't being reported and we're never going to know. I mean, that's the whole problem. Data is data, right? Tough to get out. So just keep that in mind. So, we're downplaying the fact that there's not going to be foreclosures or they're not going to make an impact. Okay. So they will make an impact. Trust me. They don't want you to know that. Okay. So According to Adam, you got locations like Nevada, Delaware, and New Jersey had the highest foreclosure rates with respect to filings. So when we start looking at some of these locations, you're going to see that I always talk about the typical groups or states or counties or cities that are always going to be leading the foreclosure charge. Right. So we've got here, Delaware, New Jersey, Kansas, Illinois. So of course, Illinois is always up there as well too. Highest foreclosure rates, for populations above 200K were Atlantic City, New Jersey, Macon, Georgia, Las Vegas, obviously, Cleveland, Ohio, Champaign, Illinois. So we're starting to see, it's starting to manifest a bit here. Now, comparatively speaking, right, this is from today, a year ago. So yeah, we're going to see increases. That's normal. But I guess my point is that it's starting to happen now. So things are opening up. Moratorium's over. We're going to see funds. Things will start to change. You just got to be patient, right? Metropolitan locations, over 1 million people. The worst foreclosure rates in July included Las Vegas, Cleveland, Indianapolis, Miami, Florida, St. Louis, Missouri. So again, big cities, cities where we have high appreciation, and we had problems in the last housing crisis. None of this surprises me, right? Every so often we see an outlier, like maybe a Delaware that comes in, or South Carolina, just because of the nature of what's going on in that month or those filings, etc. But typically what we're seeing here is the same, all right? Now, other states could still have foreclosure moratoriums going on, like New York and California. So, there's fighting going on there. Typically what we see is those are much more pro-tenant renter versus landlord states. So those tend to be where there's more moratorium backing, etc. Again, it's going to start to crap out at some point in time. So we're going to see pockets having issues across the country. Eventually, it'll sort of increase and go from there. So foreclosure starts increase monthly in 23 states nationwide. Okay, so basically, lenders started the foreclosure process on about 6,500 plus properties in July, down 4% from last month, but up 45% from a year ago. So the thing is, like last year, during right in the middle of COVID, nothing was happening. Okay, you can take a look at foreclosure starts, basically nothing going on. So now up 45% is an increase. It's not where it was pre-COVID pandemic level, but we're going to get there. Okay, again, we have decreases now. North Carolina, Arizona, Georgia, Illinois, which is weird on foreclosure starts, but that's just because again. We're going to get back into it, right? Increases: New York, Riverside, California, Chicago, Illinois, Atlanta, Georgia, Houston, Texas. So it's a bit of a, I guess you could say, semantics here, but we've kind of got certain states. You can have a state with an overall decrease, but a city with an overall increase. So I guess it depends on how we look at this and how they produce the reports. So, and foreclosure completion numbers increased 5% from last month. So what's happening now, what mainstream is telling us is that, well, the foreclosures that are vacant properties, zombie properties, those we can foreclose on because nobody cares. No one lives there. We're not displacing any occupants. So that's going on. That's always gone on for the past few months anyway. But as I mentioned, certain states, like for example, Florida, our stuff did open up, and it's just a matter of lenders pushing stuff through their attorneys, courthouses, this like the process being opened up more to have more volume. So we've seen it for the past couple months. We're going to see upticks in that right now. So there you go. REOs, real estate owners, are bank owned. So essentially, we're seeing an increase in Kansas City, Missouri, Chicago, Illinois, Baltimore, New York, Philadelphia. So again, places where there's typically a good population, I'll call a varying degree of real estate values and segments in the marketplace. That's what we're seeing right now. So it's interesting, and it will continue. Let's go next slide here. By the way, if you're not already a subscriber, if you could do me the great honor and smash that subscribe button, that'd be great. Like the video too. And if you're not a subscriber, or if you think you're a subscriber, could you please double check and resubscribe to help me maintain my position with subscriber base and grow as well too, because things happen behind the scenes that are, I call them shenanigans, right? So thank you very much. I appreciate that. Now, again, back to mainstream. What are we going to see here? Well, delinquencies elevated but declining. So you know what? Maybe we're not getting as many new delinquencies coming now, but it'll start to pick up again. All right. So I just look at it going, it's just, how can I put it? We're grasping at information. We're grasping at, something we can talk about that's good to show the American population, to say, hey, listen, everything's great. Don't worry about it. And as I said before, the more you push me to go over here, the more I think something's going on over there. And that is the case in the housing market here. Now, but if you start really delving into a lot of, different websites, blogs, whatever. Well, I'm starting to see these type of headlines. It's not a matter of if, but when this housing bubble will burst. So, back, as I said, a year ago, we're not talking about this. We have delays, forbearance, restrictions, moratoriums, all this type of stuff. Property values increase, housing narrative comes into play. Nothing. We're not going to have a problem. The foreclosure bubble bros, they're smoking crack, whatever it is. Don't believe them. They want things to happen. Listen, I want normalization in the marketplace. I want affordable housing for everybody. Okay. Yeah, there's always going to be locations that are going to spike and they're going to decline. But in the end, I don't know, like so many analysts, economists, whatever, Fed presidents, whatever, have come out saying that this cannot be sustained, all right? And you take a look at housing sentiment. University of Michigan puts out a monthly housing sentiment. Housing sentiment, which is home buyer sentiment, is at its lowest point it's been in years. And the reason being because house prices are too high, inventory is too low, competition. People believe that buying a house is the most stressful thing they're going to experience in their life. So that's where we're at now. So things are changing. A little bit of inventory coming on now. We'll see some price decreases, a little shift. This is the start of what's going to happen as time goes on. So my point, though, is that we're starting to see more headlines and more articles like this. Now, this was interesting, too, because I saw this morning. That's why I put it on here. So asking their lender to accept net proceeds short of their outstanding mortgage. I'm like, that's a big, long phrase that says short sale. That's what that really is. So if you read this little bit in the article, I just put a little blurb here. I'm actually going to go to the meat and potatoes of it. Essentially, a realtor in Central Maryland says he's seen a resurgence in real estate practice that has been uncommon since the housing crisis of 2007, 2008. All right. This dude basically said he's noticing an uptick in short sales on homes in the region, basically asking their lender to accept the net proceeds of the property short of their outstanding mortgage. That's why it's called a short sale. So short sale basically is we're buying it for less that's owed. The lender, servicing company, bank, whoever it is, has to approve that and for the sale to close, okay? So he's described the process as a short sale. I just spoke with an appraiser just a few days ago. They had 13 orders just for doing appraisals for short sales, which is really interesting. So he also says some of the upticks in potential short sales come from the landlords and property owners who may be unable to keep up with bills and payments as some pandemic eviction moratoriums continue. So bingo, right there. And we all know when we start talking about wealth transfer and what's happening with housing in the future, I've been very clear in this and very bullish talking about the fact that it's the small investor, the mom and pop investor that has a handful of properties, usually under 10 properties, that are the target because they don't typically get forbearance. They don't get any relief right now. If your renter's not paying you, they could have not paid you for 15, 16 months now. They're not applying for rental assistance. You're going to apply for it, but they have to participate for you to get it. They're not doing it. What's in it for them? They don't care. They think they got moratoriums to protect them. They've made very well in different locations. So it's squeezing the landlords big time. And as much as people might say, well, landlords, investors, they don't deserve, protection, whatever. Well, yeah, it's a risk, and you're a risk if you're an investor, and you have to realize that. But rental property is a big part of the overall real estate marketplace, right? There's always going to be the need for rental property, whether it's people who can't afford homes, people who are transitioning, people who are moving to different locations. So there's a need for rental property, and that market is being punished now. And what's happening is the fact that, well, if I'm a landlord and I say I evict somebody, what's going to happen? Well, the next person I'm going to put in there, I'm actually going to have more criteria. I'm going to charge them more rent. And so what really happens is the affordable housing needs get further squeezed and punished because of what's happening right now in the marketplace. So why do I want to put somebody in who can barely qualify, who's probably not going to pay me, and we're going to go through another year, 15 months of this, right? So this is what's going on. So, as much as this may be protecting, we'll say, a segment of the population that are renters that need this, it's also going to hurt the rental segment as time goes on, big time. I can tell you that right now. Rental prices in our area have skyrocketed. Criteria is up. People are having a hard time finding a home, and what they're being offered for rent is ridiculous, and the competition to rent is ridiculous as well too. So big joke out there right now. It's the way it goes. So again, but my point to everybody here is the fact that now we're talking about it. Now it's out in the open. So a few months ago it was, don't even talk about this. We're not going to talk about this because it doesn't make sense. The narrative is X, or everything's going to be good. Cash out your equity. Well, guess what? These people here, they're not cashing out their equity. They're going into short sale because they don't have equity, or when you do the numbers, they're below underwater. And one thing I want to point out as well too was Adam did put out their other day. I guess they have what's called their home equity report when they talk about properties with equity and properties that are underwater. Well, I've noticed a slight shift in how they produce that. What I mean by it is just on their articles, but they don't talk. Before they would say we've got 3.5 million underwater homes. Well, they're not talking about the statistic anymore. They're talking a percentage. So when you read the article, it's kind of like, well, 34% of the homes are high equity. Whatever, I forget, 4 or 5% is negative, seriously underwater equity. But it's almost like when I look at that as going, they don't want to talk about it because it's actually maybe not what they want to talk about in the media, right? It's not proactive for them, or for whatever reason, or they've been slapped and said, do something different. So that, or they're kowtowing to somebody else, as far as I know. But again, my point is that we're not talking negative. We only want to talk positive, and the negative's coming. It's the way the market has to play out. Simple as that. I don't see any other way. In case you're looking at that. So, and so it begins. Well, now the shift is starting. So July 31st, things have changed in the marketplace. Things will continue to change. Things will go down a certain path, and it's something you probably want to be aware of, right? So everyone's talking about this now. So basically, my inquiries have skyrocketed on a number of different issues for different people, groups, whatever. So large investors are ready and waiting to pounce. So people like the large investor groups, like the institutional investors, the big hedges, whatever, they know stuff's going to go to foreclosure. They're ready and waiting. There's articles about them buying over market value right now. Why would they buy over market value? Because the rental rates support them overpaying for a property, and then they're going to jump in on the foreclosure side and buy stuff below market value and still keep the rental rates up. That's what's going to happen. Other investors are inquiring and positioning. What I mean by that is, hey, we want to do short sales. We haven't done short sales before. We want to get involved. Can you help us? So I'm fielding a lot of those requests right now. We'll continue to. So if you want to get involved with me, reach out to me. Okay. Primary home buyers want it, and everybody now goes, yeah, now maybe it might be my time to buy in the future. So something to think about. All right, to take a look at this. Now I can tell you that your real estate agent's not going to have a silver platter of short sales and distressed property to bring to you in your armchair where you can pick and choose. That's not going to happen. So you need to figure out how to navigate this, do more work on your own so you won't be disappointed. All right. Other real estate agents need info. Of course, I get a lot of inquiries. People, if you're a relatively new real estate agent, I mean relatively new, the past maybe 5-6 years, chances are you've never done a short sale before. And you know what? You might think it's easy. You might take a 4-hour course with a designation, but you know what? You don't really know what's going on there. And yeah, there's a lot of stuff happening in the marketplace, but you might be better served to understand what's happening because short sales can be problematic on every front. And there's a reason why they have a bad stigma. All right. Info market world. The info market world is heating up for real estate investment. What I mean by that is I'm on a lot of people's lists because part of my business, every day when I'm looking, it's like, okay, moratoriums ending, cheap REO prices, shit, like everyone's talking about the foreclosure wave coming. Now, mainstream media downplays the foreclosure tsunami, which I get. It's not going to be a tsunami. It's going to come in little waves and it's going to slowly increase over time. But the fact is they're going to be there. Now, if you're thinking about doing this, now's the time to get involved and get prepared. We're already starting to see stuff happen. I'm already starting to do that right now. Okay, just like the previous housing crisis, this has all happened. So really, before people were doing fix and flip and cash flow rentals and just buying and selling, because it's like, hey, I'll buy it now and I'll sell it for $100,000 more next year and make 10%. Oh, what's my back play is the fact that I just break even, then I'm okay, right? Well, guess what? That didn't happen in the last housing crisis. Things tanked, all right? So people remember that, and everybody migrated into distressed property, which was foreclosures and short sales, all right? So keep that in mind. This could be the last time we see this because a lot of changes are happening in the marketplace. I see, the government getting more involved, Wall Street heavily involved here, the more iBuyer applications happening here. So I see a lot of shifting, not just on the actual home value front, but other ways of doing real estate that might make it a little more difficult for the average person, the average primary home buyer to actually purchase a property. So this could be the last time we see this opportunity right now. Things can figure out, differently in the future, next cycle, but we're kind of in this cycle now that we need to run for the next 2 or 3 years for sure. So keep that in mind. Do not be on the sidelines, all right? Why do I say that? Listen, this is an example. I show you guys this slide every time in my videos. $75K in equity difference between the median house price and my greater Tampa Bay MSA versus a short sale. So a retail price $322, $257 for a short sale. So therefore, there's equity if you pursue this, and that's what the most important thing is. So there are deals to be had out there if you know what you're doing. So I say to people, do you want to know how to acquire a property that is $75,000 under fair market value? They need to give me a call. Simple as that. All right, and we can see that this is a bar graph from the most recent report from the National Association of Realtors. Look at the fourth column in. Distressed sales are only 1%. So only 1% of what's distressed sales, which are short sales and REO, bank-owned, foreclosed properties on the MLS. So less than 1% are short sales, which means that no one's doing the business, which means that's the opportunity. I've stressed this so many times. I don't know why people aren't jumping on this, all right? Because I said, things are not going to be like the last time around where stuff was sitting there you could pick off, get a good price. It's not going to happen that way this time around. So you need to be prepared for that. And that's my point to all this. So and I always say, how would you like to sell a property and make $75,000 income? So if you acquire it and you can do some work to it, fix up whatever, there's going to be a market for that. So great opportunities if you want to understand where this market's going to figure it out. So I can teach people. I can tell you how to engage the distressed housing market. Just connect with me. There's my email. Give me your phone number so I can contact you. We'll go from there. So once again, guys, appreciate the views, likes, comments. Please share the video with your family and friends. If you're not a subscriber, please subscribe. I look forward to speaking with you in a couple of days. Take care.